You don't often see that in press releases.
Never.
In
Somebody
terms
better lose a job there, as Alex was
Totally.
saying.
But at the end of the day, it was, I think, just a mistake that happened. It wasn't intentional in any way, and the stock move was pronounced because of the short interest and the fact that obviously people were not very optimistic going into the print. And look, I think in the case of Lyft, not much has changed in terms of execution. They're still kind of a distant number two. And you talked about taking a Lyft, but there are certain zip codes where they are able to meet the ETAs that Uber has, but in other zip codes, they have no supply. So even if you want to take a Lyft, there is no availability.
All right, but my dude last night, like most markets I go to, he's got an Uber sticker and he's got a Lyft sticker, and he's got both apps open.
Wait, really?
And they all drive for each other.
Yeah, there is
totally
a huge amount of overlap.
Yeah. And so literally,
Such a
it's
newbie,
just
apparently.
it's just here's my reading. I mean, you're the expert. It's just Uber algorithm, Lyft algorithm. They're different. They're going to give you different prices and things like that, but. It was 20% difference.
But
Anyway.
from a driver perspective, what Lyft is doing is they are paying out more to lure drivers.
Okay.
So if it was a $10 ride, the driver is getting $7 or $8 from Lyft, whereas from Uber they're getting $6. It's just an example.
Yes.
So that's where the take rate matters. What
Yep.
these companies keep versus what the driver is getting, and that's the I think tactic Lyft is using to really pay more to the driver to bring on more supply.
So then how does that then play out? So at some point they get enough supply that then they can sort of make more money per ride and increase the shares. When does that moment happen?
I mean, scale is the only moat you can have in this business, scale and operating efficiency. And so what Uber has done is, obviously they have the scale. They are 6 times bigger than Lyft in just the mobility segment. And think of the gross margin. The reason why this is a 60% gross margin business is because insurance costs is pretty high for ride sharing. So how do you bring down insurance costs? Through scale. And that's what Uber has, because it does 6 times more rides than Lyft. And in the case of Lyft, if they don't maintain the supply, then they're just going to keep losing share, which is what was happening. So they have to compete on price. The only way they can maintain their share is if they offer a lower price, as they did with Paul last night. So that's the tactic, and I don't think it's going to be.
Is that a long-term model to you?
Well, so think of what happened with food delivery. There were so many players. Now you're down to 2 or 3, remaining. It's Uber,
Which,
DoorDash.
by the way, I still will not pay for my youngest in college.
I have a hard time paying for it. I'm not going to pay $10.
We've established that firmly.
I support this.
Yeah.
So there will be consolidation, but if Uber is announcing a $7 billion buyback, they're not buying Instacart now. So nor they are buying Lyft.
Okay, talk about that that buyback.
Yeah.
What does that tell us? Like, when you buy back stock, isn't that because you're no longer a growth company? Like, is that the thing?
Yes, I think there is that element. And also they're going to be prudent in terms of returning cash to the shareholders. So remember, they acquired the freight business. That is a big drag on profitability. Uber didn't build freight business organically. They bought a company. That didn't work out well. They bought Postmates for food delivery. That didn't work out well. So their track record with acquisitions isn't great. And so now they are saying we are going to generate about $7 to $8 billion in free cash flow. Well, guess what? We are using $7 billion out of that for buying back our stock. I mean, obviously it's going to be over a period of time, not in the next 12 months. But I think that's good, sound capital allocation strategy. And look, this company is generating, the mobility side is very healthy. They've got, mid 20% EBITDA margins. Compare that to Lyft, which what got people excited is they could get to 20% EBITDA margins. Well, not so fast. I guess that was a typo.
So I say, all right. How about the Uber Eats business? Again, I don't support this. I mean, I know it's a great, people love it, but not on my credit card. So talk to us about the Eats business.
This is just to drive frequency.
Okay.
Just so that Paul has more transactions with
This is just
Uber.
advertising then, basically.
Exactly. And the only profit they're going to generate right now is through advertising. So the good thing working out for Uber is they have a memberships business. So that's your recurring subscription. You're going to buy an Uber membership that works for both mobility and delivery. And also they're going to show ads. So ads is a $1 billion run rate business now, primarily driven by delivery, and it's almost 90% gross margin.
Yep.
So that's what's going to drive the delivery profitability. But on a transaction basis, this is zero.
So this is sort of like Amazon Prime Video. Like it's just basically sell more subscriptions of Amazon Prime, up the price a little bit, and then you get more viewers who are just into it, and then they buy more stuff on Amazon. It's kind of the same
bundling
idea.
is the way. So they like Uber talked about this concept of being a super app almost 3-4 years ago, and they have been working towards it. Now they have integrated taxi. Remember when Uber came to the scene? They were supposed to, or they actually disrupted taxis.
Yep.
Now they have onboarded taxis on the platform to boost supply. And taxis is about 5% of their business. So clearly, you come a full circle where you have integrated taxis, and their thing is, we'll bring everything related to transportation on one app. And you can find any and everything you need.
This guy, Dara Khosrowshahi, I mean, he's done an amazing job turning that company around.
Minus the acquisitions.
Minus the acquisitions.
They're just bad at buying stuff.
And that's what he did at Expedia. Expedia was built around acquisitions. There, I think acquisitions worked out probably better than they did in Uber. But clearly acquisitions wasn't.
And so one of the potential acquisitions that was out there was Instacart to ramp up their Uber Eats. But you're now saying the stock buyback signals that unlikely to do that.
That's completely out of question. I mean, the question is, can DoorDash buy something given, like, the reason why Lyft's stock moved this much is because the valuation is like 1 times EV to sales.
Yep.
Compare that to DoorDash 5 times EV to sales, or Airbnb 10 times EV to sales. So clearly, a lot of the growth prospects are reflected in the Lyft's valuation.